I have watched markets long enough to know that the most dangerous moment for an investor is not always the moment when business conditions are the worst. Very often, it is the moment when the noise is the loudest war. Headlines start flashing across the screen. Oil spikes, commentators begin speaking faster. Every hour brings a new explanation for why the world has suddenly become uninvestable. A labor report comes in softer than expected. A strategist announces that stocks will rise first and collapse later. Another guest goes on television to say artificial intelligence is about to wipe out half the job market. Everyone has a chart, everyone has a warning, everyone has a reason to be afraid right now. And in the middle of all that noise, the market quietly does what it has always done. It starts throwing some very good businesses overboard along with the weak ones. That is the part most people miss. They think the opportunity arrives when life feels calm and when the valuation looks obvious and the crowd is cheerful and the headlines are supportive. It rarely works that way. The real opportunity often arrives when the facts of the business are still strong, but the emotional environment around the stock has become hostile. That is when people start confusing price movement with business deterioration. That is when a great company gets treated like a bad one simply because it belongs to the wrong category at the wrong time. That is when the market stops asking, "What is this business worth over time?" and starts asking, "What if the next quarter disappoints? I have made a great deal of money in my life by caring much more about the first question than the second one." I do not ignore risk. I do not ignore war. I do not ignore oil. I do not ignore interest rates, but I also do not let those things bully me out of thinking clearly about business quality. When fear gets concentrated in a market, it does not only hit the fragile companies, it hits the obvious compounders too. It hits the businesses that are deeply embedded. It hits the companies with pricing power. It hits the companies with network effects. It hits the companies with customer habits that are far stronger than the market mood. And when that happens, the investor who can separate narrative from economics gets a chance that the emotional investor never even recognizes. That is the frame I would use when I look at the sell-offs that have been appearing beneath all the macro chaos. The headlines want you to stare at Iran, oil, labor, software, recession probabilities. And whatever prediction is going viral this week, I would rather start with a simpler question: which businesses are still likely to be much more valuable 5 years from now than they are today? Even if the market is nervous this month, that question eliminates a lot of distraction. It does not answer everything, but it points you toward the right kind of work. It forces you to study the engine, not the smoke. And when I look through that lens, I see several businesses that the market has sold down not because their long-term economics have suddenly become poor, but because fear, compression, uncertainty, and short-term narrative have all been piled on top of one another. The first kind of business I pay close attention to in that environment is a business whose product has become a common language. That is, once a company becomes the standard way institutions communicate value, risk, trust, or creditworthiness, it stops being just a product and starts becoming infrastructure. That is how I think about FICO. Most people see a score. I see a language that distinction matters. A lender does not simply use FICO because it is familiar. A lender uses it because other lenders use it, because underwriting systems use it, because borrowers understand it, because mortgage markets recognize it, because regulators and institutions have spent years building around it. And because once a language becomes dominant, the burden of switching is far greater than outsiders assume. People often make the mistake of thinking a moat exists only when a product is technically superior. That is not true. A moat can also come from standardization. A moat can come from trust. A moat can come from the fact that millions of decisions are already linked to a single system. So even a cheaper alternative still has to overcome inertia, workflow, habit, data continuity, and social acceptance. That is the strength in FICO. Now, the market has not been blind to that strength. For a while, it rewarded the company with a rich valuation. And when that happens, you have to accept a simple truth. A wonderful business can still be a poor stock if you pay too much for it. Part of the recent decline comes from that. Expectations ran ahead of reality. Multiple compression is real. It hurts, and it usually hurts precisely the companies people were previously most eager to overpay for. But the market is not only worried about valuation, it is also worried about softer guidance. It is worried that pricing will not keep squeezing as aggressively as investors hoped. It is worried that VantageScore and other alternatives might gain more traction. It is worried that artificial intelligence might create new scoring approaches and reduce the force of the moat. Those concerns are not imaginary. They are simply easy to exaggerate. I have never believed that a strong franchise becomes weak the moment a competitor announces a cheaper option. If that were the case, Coca-Cola would have disappeared a long time ago. If that were the case, American Express would have been reduced to a commodity decades ago. A franchise survives because customers are not buying a line item on paper. They are buying reliability, acceptance, continuity, and the comfort of a known standard. Even if a rival score is free, it still has to become the shared language of the lending ecosystem. That is a much harder battle than investors remember during a sell-off. So I do not ask whether FICO can be challenged. Every business can be challenged. I ask whether the market, in its current fear, is confusing challenge exists with economics are broken. Those are not the same sentence, and when they get treated as the same sentence, opportunity appears. The second type of business I like to study during a market scare is the one people misunderstand, because it spent years building scale before the cash really showed up. Once the operating leverage arrives, the conversation changes. Suddenly, what looked messy starts looking inevitable. Uber fits that pattern. For years, many investors treated Uber as a story stock, a company with activity but not enough dependable earnings power. A platform always one regulatory shift or competitive panic away from disappointment. Then the economics started to tighten, scale improved, cash generation improved, the network became more obvious, the platform became more useful to more people in more ways. That is the point where the market usually starts giving a business credit for maturity. Then fear returns and takes some of that credit back. Now, investors look at Uber and see a different set of anxieties. They worry about robotaxis. They worry about autonomous competition. They worry that the current system is simply a bridge to a future in which someone else owns the value. I understand why that story travels well. It is futuristic. It sounds disruptive, but disruption narratives often move faster than business realities. A transportation platform is not just an app that matches a rider to a vehicle. It is routing, payment, habit, frequency, local density, brand behavior, consumer trust, merchant relationships, driver supply, service layering, and operational learning across regions. The idea that all of that simply evaporates because a new technology exists is a very market-like fear. It is not always a business-like conclusion. In many cases, the winning platform in a changing market is not the company with the most interesting hardware demonstration. It is the company that already owns the demand, the customer touchpoint, and the behavioral loop. Uber has real advantages there. It also has something else I always like to see after a period of skepticism. It has begun to show what the business can look like when the scale is already built and the cash flow starts dropping through. That changes valuation math in a hurry, and yet because the stock sold off from higher levels, many people now talk about it as though the business has been disproven. That is the trap. A business can be better while the stock goes lower. A business can be maturing while the multiple falls. A business can be strengthening while the narrative turns suspicious. If you cannot hold those ideas in your head at the same time, you will miss a lot of good investments. The third kind of opportunity appears when a dominant business gets shoved into a broad fear basket that treats every company with similar surface characteristics as though they face identical risk. That is happening all across software. It is happening to Intuit. A lot of investors see artificial intelligence and jump directly to a lazy conclusion. If software becomes easier to build and if language models become more capable, then all software incumbents must be in danger. That is a neat theory, but neat theories are often too tidy to be useful. Taxes are not merely a data entry problem. They are a trust problem. They are a compliance problem. They are a liability problem. They are a habit problem. Most people do not wake up in the morning hoping to experiment with prompts to see if a model can correctly process every local, state, federal, filing, deduction, documentation, and record-keeping issue attached to their life. Most people want relief. They want convenience. They want confidence. They want a system that carries the burden for them and presents a path that feels safe. That is why TurboTax is not merely a form filler. It is a trusted behavior. It is a workflow. It is an annual habit tied to anxiety reduction that matters more than technologists usually admit. Could artificial intelligence improve tax preparation? Of course I would expect it to. But the value may go to the incumbent that already owns the trust relationship rather than to the outsider who only owns the clever interface. Markets forget that. They assume new technology automatically reshapes customer behavior. Sometimes it does. Very often it gets absorbed by the strongest existing distribution. Intuit also suffers from the same thing many great businesses suffer from after a long run. The market becomes accustomed to paying a premium for excellence. Then the first meaningful threat appears, whether real or exaggerated, and the premium collapses. When that happens, investors stop talking as if the company is indestructible and start talking as if it needs to prove its right to exist. That shift in tone can be violent. It does not always reflect a violent shift in the business itself. I would rather own a strong company when the market demands proof than own a weak company when the market is offering blind faith. Blind faith is expensive. Demanded proof is often cheaper. That is why sell-offs in dominant but temporarily doubted franchises deserve real study. Now, when I think about Microsoft, I am thinking about a different kind of tension. Microsoft is not being sold because investors suddenly discovered it is a bad company. No serious person believes that. It is being sold because the market is wrestling with what happens when one of the greatest software businesses in the world starts spending money at a scale that makes people wonder whether the future return on capital will look as beautiful as the past one. That is a valid question. Capital intensity changes the feel of a business. When a company has historically looked like a high-margin, capital-efficient machine and then begins pouring massive sums into infrastructure, investors naturally become less comfortable. They start asking whether the economics are shifting. They start asking whether the old margin picture was the exception and the future one will be rougher. They start asking whether the company is anchoring itself too closely to a single AI relationship. They start asking whether software itself will be attacked by the very intelligence wave that Microsoft is trying to monetize. Those are serious questions, but they should be asked in proportion. A business like Microsoft possesses one of the deepest installed bases on Earth. It possesses enterprise trust. It possesses integration. It possesses workflow dependence. It possesses a balance sheet that lets it absorb strategic uncertainty better than almost anyone. It possesses distribution that turns new capabilities into customer adoption faster than smaller rivals can manage. In other words, even when the company is spending heavily And even when investors are right to worry about return on that spending, the franchise itself remains extraordinary. That does not mean every dollar of capex will produce attractive returns. It means the market should not move from the future is less certain to the moat has been compromised without evidence. This is where many investors get themselves into trouble. They confuse a reduction in confidence with a collapse in value. Those are not the same thing. If the stock falls because a formerly adored company is no longer being priced at perfection, that can be painful for recent buyers, but for rational buyers, it can be useful. I have always preferred buying a magnificent company at a valuation that reflects questions rather than adoration. Questions do not scare me. Adoration does. Now, Brookfield is a different animal. Brookfield is not living inside the same software panic. It is living inside macro fear. That matters because macro fear often produces a very different type of mispricing. People begin reasoning from headlines instead of asset quality. Oil goes up. Inflation fears reappear. Investors assume rates might stay high for longer. Once that assumption starts moving, anything tied to long-duration assets, financing environments, capital recycling, or rate sensitivity gets handled roughly by the market. Brookfield ends up in that blast zone. Yet when I look at a business like Brookfield, I am not trying to predict the emotional temperature of the market in the next month. I am looking at whether the capital allocation machine remains sound. I am looking at whether management understands how to own and recycle assets across cycles. I am looking at whether the company has the patience and structure to take disorder and turn it into opportunity. That is the real attraction. Bruce Flatt has earned the right to be taken seriously because he has spent years operating in areas where many investors are uncomfortable. Hard assets, alternative assets, infrastructure, complex capital structures, long-duration opportunities. Those businesses do not always look pretty in a world that wants instant clarity. But over time, skill in allocation matters. The market may decide for a period that a company like Brookfield should be marked down because the rate path looks less favorable than investors hoped last quarter. Fine. That does not change the quality of the allocator overnight. That does not invalidate the long-term compounding ability of the platform. It simply means the market is once again pricing near-term macro uncertainty more aggressively than long-term business capability. That can be unpleasant in the moment. It can also be a gift. Then I come to SP Global, which is another example of what happens when a great franchise gets pulled into a broad narrative that sounds convincing because it contains a piece of truth. Yes, artificial intelligence can change the way information is processed. Yes, data can become more searchable. Yes, some forms of analysis may become cheaper. But cheap analysis is not the same thing as trusted data. Institutional workflow integration, benchmark authority, ratings relevance, index dependence, and the embedded role that a company like SP Global plays in the functioning of markets. That is where investors need discipline. A new technology may reduce the cost of some tasks. That does not automatically dissolve the value of the institution that standards, packages, validates, organizes, distributes, and embeds information into the way capital actually moves. Markets like to imagine sudden displacement. The real world usually looks more gradual. SP Global also has another trait I admire in periods like this. Management is willing to act when the stock is down. Aggressive buybacks during pessimism are one of the clearest signals a company can send if management knows the business remains strong and the market is being overly harsh. When the company itself becomes a major buyer during a drawdown, I pay attention, not because buybacks solve everything, they do not, but because capital allocation behavior during fear tells you something about internal. If you step back, What ties these businesses together is not that they are identical. They are not different industries, different risk factors, different reasons for the sell-off, different shapes of moat. What ties them together is something simpler. Each of them is being judged not only on current facts, but on current mood. Mood is a terrible way to value a business. Mood can change in a week. A strong business can remain strong through a period in which the market mood becomes almost comically unstable. That is why I never let broad market panic do all my thinking for me. I want to know whether the economics are deteriorating, whether the moat is weakening, whether customer behavior is changing, whether capital allocation is becoming reckless, whether pricing power is fading, whether management integrity is slipping. If the answer to those questions is truly negative, then a lower stock price does not make the company a bargain. But if the answer is mostly stable and the market is simply compressing valuation because the environment feels dangerous, that is precisely when I become more interested. This is also why I am careful with market commentary. I listen to it, but I do not let it run the portfolio. One strategist says the market will rally into month end and then fall into a bear market later in the year. Maybe another insists higher oil and higher rates are somehow bullish for equities because the stock market is not the economy. That is where I part company with a lot of television logic. It is true that the stock market is not a perfect mirror of the economy in any given week. It is also true that over time businesses make money from real people, real spending, real demand, real margins, real financing conditions, and real economic behavior. You cannot sever those things forever and still pretend valuation is grounded. If oil rises meaningfully, if financing costs stay elevated, it matters. If consumers become pressured, it matters. If companies begin cutting back, it matters. The market may ignore those facts for a while. It cannot repeal them. So I do not celebrate higher oil and tighter conditions as though they are harmless, so long as a handful of growth stocks can keep climbing. That is not how durable investing works. I want to understand which businesses can keep compounding through changing conditions, not invent a convenient theory that harsh conditions somehow do not matter. That is another reason I return to business quality during noisy periods. If I own a weak company, then I have to obsess over every macro turn because the business itself cannot carry much. If I own a strong company bought at a more sensible valuation, I can survive a lot more noise. That is the real advantage. Not prediction, not cleverness, durability. The same principle applies when the conversation turns to artificial intelligence and employment. I have seen this movie before, only the costumes change. Every major technological shift arrives with two competing stories. One is practical, the other is theatrical. The practical story says the technology will improve productivity, alter certain workflows, eliminate some tasks, create other tasks, and eventually get absorbed into the economy in messy, uneven, but generally constructive ways. The theatrical story says millions of people are about to become obsolete. Whole sectors will vanish overnight. Social order will come apart. And only panic or government rescue can save the future. The theatrical story always gets more airtime. It is more emotional. It is more clickable. It is better television. It is usually a worse guide for investment judgment. When I hear someone come back from a conference and announce that the next 6 months will outstrip the last 10 years, and that whole white-collar categories are about to disappear, I do not assume I am hearing wisdom. Very often I am hearing promotion, extrapolation, or selective evidence dressed up as certainty. Of course, some entry-level roles may become harder in specific segments. Of course, hiring conditions can tighten in areas that were previously overheated. Of course, recent graduates may face a tougher market if firms overhired a couple of years earlier and are now holding on to existing employees instead of expanding at the same rate. That happens in normal economic cycles too. What I reject is the leap from some categories are tightening to the future is desolate and the labor market is collapsing. That is not analysis. That is theater. Take coding. People assume that if software tools make developers more productive, fewer developers must be needed. That sounds logical until you remember what happens when a scarce and valuable input becomes more productive inside a market with enormous demand. Return on talent can rise. Projects that were uneconomic can become economic. Companies can justify more product development, not less. More cash flow can support more hiring. The task mix changes. The value of judgment, architecture, taste, integration, oversight, and application can rise while some of the repetitive labor falls. The economy has done this dance again and again. Technology reduces the burden of some work and increases the scale of other work. The invisible part is always what comes next. People can see the threatened task. They are terrible at seeing the future opportunity. That is why pessimism sounds so intelligent in real time. It names the job at risk. It rarely names the jobs, industries, products, and demand that productivity will unlock later. The same exaggeration shows up in trucking. People talk as though autonomous systems mean millions of drivers simply disappear. That view is detached from the actual complexity of the job. Long straight highway mileage is only part of the work. Weather, loading, inspection, routing, customer coordination, safety judgment, equipment handling, and operational accountability are all part of the real task. Assistance technology can improve the economics and safety of the work without removing the need for people in the way headline-driven thinkers imagine. Investors should care about that distinction. A tool that complements a workforce can be very profitable. A narrative that declares immediate replacement may simply be false. So when the market gets caught between war fears, oil spikes, software panic, AI job hysteria, and endless strategist forecasts, I return to a very old habit. I simplify. I ask what will still matter after the noise has changed. Will lenders still need a common credit language? Will consumers and merchants still rely on a dominant mobility and delivery network? Will taxpayers still prefer a trusted, guided system to an improvised experiment? Will enterprises still depend on the software backbone and distribution reach of Microsoft? Will long-cycle assets still reward a skilled allocator? Will capital markets still lean on trusted benchmarks, ratings, and standardized information? Those are durable questions. They have nothing to do with whether television is frightened this afternoon. They have everything to do with where wealth is built. I am not saying every stock in a drawdown is a bargain. I am not saying risk is imaginary. I am not saying valuations cannot fall further. What I am saying is that the market often becomes least rational when it feels most informed. That is the paradox. A flood of news creates the illusion of clarity. In truth, it often creates emotional contamination. Every new data point gets interpreted through fear. Every uncertainty gets rounded upward. Every risk gets treated as permanent. And every strong business gets forced to defend itself against the harshest possible narrative. That is not the time to join the shouting. That is the time to read. That is the time to compare temporary pressure with permanent earning power. That is the time to separate a narrative bruise from a structural break. In my experience, the investor who can do that is the one who ends up buying tomorrow's obvious winner while it still looks uncomfortable today. People like to talk about courage in investing as though it means being fearless. That is not what it means. Courage in investing usually means being willing to look foolish for a while because you are anchored to business value instead of social reinforcement. It means being willing to buy when the chart looks ugly, but the economics still make sense. It means being willing to disagree with a crowd that is armed with 1,000 dramatic reasons and very little patience. It means understanding that compounding machines do not always trade at prices that reflect their real long-term power, especially when the market is busy worshiping or fearing something else. That is why I keep coming back to the same lesson. Do not let macro noise trick you into handing great businesses back to the market at a discount. Do not let category panic convince you that every dominant company has suddenly lost its moat. Do not let a viral interview distort your understanding of durable economics. And do not assume that because a stock has fallen, the business has failed. Sometimes the opposite is happening. Sometimes the business is still doing exactly what a great business does. It is serving customers, deepening habit, strengthening integration, generating cash, and setting up the next few years of compounding. The only thing that has really changed is the mood around it. Mood is temporary. Business value, when it is real, tends to reassert itself. That does not happen on command. It does not happen on television's schedule. It does not happen because a famous investor owns the stock, and I would never buy something merely because another smart investor holds it. Great investors can be wrong, and concentration by itself is not evidence. But I do respect when thoughtful investors repeatedly cluster around the same types of businesses. It often tells you where deep work has already uncovered unusual quality that does not replace analysis. It directs attention, and attention placed on the right business at the right moment can be very valuable. When the market becomes obsessed with what might go wrong next week, I become more interested in what is still likely to be true 5 years from now. That is not because I am indifferent. It is because I know the present is where prices get emotional, while the future is where value gets proven. If you can keep your head while everyone else is renting theirs out to panic, you do not need to win every argument. You only need to buy enough strong businesses when they are being judged too harshly. That is how wealth compounds, not by reacting to every siren. Not by pretending risk does not exist, not by hiding from volatility, but by recognizing that chaos has a habit of offering discounts on quality to the few people who are still willing to think. That is where I would keep my attention, not on the loudest fear, on the strongest business, not on the most viral warning, on the most durable earning power, not on what the market is screaming about today, on what the business is likely to become over time. That is still the game. It has always been the game. And in moments like this, when the noise is loud and the drawdowns are real and the mood is weak, the game does not disappear. It simply gets easier to misplay. For the patient investor, that is often when it gets more attractive.